Started reading the question. Current bottling company is considering replacing one of its bottling machines with a more efficient one. The old machine has a current net book value of 2,400,000 with a remaining useful life of 5 years. The old machine has an estimated resale value of 200,000 shillings at the end of its useful life. The existing machine's current disposal value is estimated to be 1,060,000. The new machine has a purchase price of 4.7 million and an estimated useful life of 5 years. The machine is expected to have an estimated market value of 600,000 at the end of the 5 years. The machine is expected to economize on electric power usage and repair costs, and this will save the company 920,000 shillings each year. In addition, the new machine is expected to reduce the number of defective bottles, which will save an additional amount of 120,000 shillings every year. The company's corporate tax rate is 30% and the required rate of return is 12%. Members, I hope we know what required rate of return is in such kind of a setting. The company provides for depreciation on a straight line basis. Assume capital gains are taxable. Members, I also want to believe we know what are capital gains required. The initial net cash outlay. Roman 2, incremental net cash flows, net operating cash flows for years 1 through to year 5. Roman 3, the total terminal cash flows. Roman 4, using NPV criteria, advise the management of this company whether or not to purchase the new machine. Now, if you read through this question, you realize they are not new concepts. They're things that you did in the paper-based examinations. They're very familiar concepts, and the outlay of this question is setting on a decision that you make. And that's why when you look at BDA, Business Data Analytics, it's a practical paper, and it relates mostly to the practical aspects of a business operation and financial decisions that are made in actual settings. So this question, it cannot be a standalone question in case an examiner slots it in the examination and at BDA level, because each question should be 20 marks to the minimum. So it might be coupled with other section of a question in case it shows up. So in the practical sense, it's a relevant decision, even for members who are practicing, who are working now. You realize that replacement of assets is real when the productivity has gone down and you have to make that decision. Now, members, let's go through it together. One, if you meet such a question on replacement, I believe you remember how you did advanced financial management. It's a concept asking you on how do you make that decision? What do you consider? And there was a formula which I believe you also did. And we are reminding ourselves. I want to give you a format for replacement analysis. Replacement analysis. Once you remember this format, you will always find it so easy. Now, when you want to do replacement and you want to analyze on the viability of the decision you're about to make, one, you need to ask yourself, are there any incremental initial investments? You are comparing your investments in the new machine you want to buy and you are also comparing on the old machine that you want to replace. When you replace it by disposing, are you realizing any proceeds? And are there any working capital injection or adjustments that you do at the initial stage? And when you talk about working capital investment at the start, you must be able to recover the same working capital in the end. So this approach will cover all those aspects. One, let us see how to get incremental initial investments. Initial investment. And incremental initial investments, we get it through a very, very simple concept. And this format always guides so easily. One, let me put this in bold. One, we normally say you start with the cost of the new machine or the new asset. Cost of the new machine or asset. Now, when you start with the cost of the new machine or the asset, I want to adjust that. And that cost of the new machine, let me say, we are starting by putting, no, I don't have to put anything because we are going to use the same format here. Then onto that cost of the new machine, the cost that you are about to spend to buy or to purchase that machine, you want to add onto it any incidental costs. When we talk about incidental costs, we mean any other cost or expenditure that will follow through with the new machine in terms of any insurance paid, for example, on the transit, given the nature of the machine, in case you incur charges to bring in that machine into your premises, any freight or transport charges, in case you'll pay any custom duty on that machine, in case there will be installation cost involved in that machine for it to be able to be ready for usage, in case it is an item or an asset or a machine that will require to be assembled, any cost related to that assembling of that machine will be part of the purchase price of the machine, and we will have to capitalize all those costs. And in this scenario, we can call them additional or incidental costs. So I will say add incidental costs. Now, I've said you can call it incidental or addition. Either way, so long as you understand what it means, it's okay. So we can say insurance on transit, in case that insurance will be needed because you're transporting the item and anything can happen along the way. In case there are any freight charges involved, then you will have to add it onto the cost of procuring the new machine. In case you'll have to pay any custom duties, then it will be part of the capitalization of the cost. In case there will be installation aspect of it, which will be involved to make the machine ready for usage, that cost you capitalize. Lastly, in case you need to assemble that machine, then that assembling cost will be part to be capitalized on the cost of bringing on board the new machine. Then, after you've considered all or any other additional costs, then you'll have your total cost of the new machine after the capitalization. And we say total cost of the new machine like that. So if I had my cost of the machine in the purchase as that, then I have all these others, then now I will add the total incremental or incidental cost, the total additional cost, I will add it to the purchase price of the new machine, and that will give me the total cost of the new machine like that. That is the format that will help you to follow through that. Then remember, we are looking at incremental initial investment. Now, as you buy the new machine, you had an old one. What do you do with it? you would want to realize any salvage value. You'll want to dispose that old machine off even as you bring the new one. So what do we say? We say when you dispose it, you need to get something in return. You don't give it for free. You're selling it, though the value might not be much because it's old and the functionality has gone down a bit. You will realize something at the end of it all. So whatever you realize when you dispose or you sell that old machine, that is an inflow. So it should reduce the amount you're spending to buy the new one. So you consider it under this section of an incremental initial investment. So what do we say? You less proceeds on disposal of that old machine. Proceeds on disposal of the old machine like that. Good. So that proceeds, you will less it. And when you less it, it will reduce the amount you spend to buy the new machine that is replacing the tired and old one. Then, in case there will be any requirement of injection or involvement of working capital at the start, that injected or invested working capital on that new machine should always be considered. So what do you do with it? You add investment in working capital. And this, you should know, this applies to the new machine. This applies to the new machine. So you will add that injection. But remember, I mentioned that working capital normally we recover it in the end, and we are going to see how that unfolds. These adjustments, all of it should give us the incremental initial costs. That should give us incremental initial costs like that. So that should be a format that is going to help us get that computation of the total incremental initial costs like that. And this, you can also call it initial outlay. And I want us to look at the required. Required part 1 was asking us what? The initial net cash outlay. Now, this is the format to get the output or the answer for the part 1 of that question. So, with this format, you already have the answer. Now, before we slot it in, let us look at what other steps you're supposed to do. And in this computation, I would want us to look at the next part. And the next part is when you talk about, remember you are selling off that old machine. And when you sell off the old machine, you are realizing some money or you are getting some proceeds out of it. But again, you're buying the new machine. This new machine that you're buying, in this our question here, you see they were telling us that the new machine will have an estimated useful life of 5 years. And the machine is expected to have an estimated market value of 600 at the end of the 5 years. So you will still have to dispose of this new machine when its life or useful life expires. So this 600 that you will realize when you dispose this new machine, what do you do with it? How do you handle it and what effect does it have? That informs what we call incremental terminal cash flows. Remember, you buying the new machine and then you also at some point will dispose it off. And if you continue reading, you are told the new machine has a purchase price of 4.7. Then the machine is expected to economize electric power usage and repair costs, and it will save the company 920. And the new machine also is expected to reduce the number of defective bottles, and that is an additional saving of 120,000. So you realize you have a lot of values to connect their dots. Yeah. So to connect all these dots, I want us to just straight away start putting a structure by asking ourselves, when you want to make a decision whether to buy the new machine or to retain the old one, we need to be able to ask ourselves pertinent questions. And these questions we ask ourselves, we are asking ourselves based on how much are we going to realize in terms of benefit. We compare the benefit and see if it is viable, or not. So let us start looking at the format. The format will follow on cash flows. And I want to just keep aside this initial incremental initial investments. Just put it at the back of your mind. We are going to reach a point when we are going to use it. For now, I want us to come up with a structure on how to move forward. In fact, let me just do it below here. Now, we are looking at savings, cost savings by this company. And the cost savings is in terms of what the new machine is able to bring on board. We are told that this new machine, the existing machine disposal is okay, that is 1060. This new machine will be able to lead to power usage economy. It will save on power usage at a tune of 920,000 each year. Then at the same time, it is expected that it will reduce the number of defective bottles by additional what? Saving of 120,000 annually. So if we connect all that information, we should be able to ask ourselves, how much are we saving by bringing on board the new machine? That will start informing how to start. And we are looking at the useful life of the new machine, which is 5 years. So year 0 is when we are doing the investment. Then we start from year 1, and this new machine should run us or should take us for the next 5 years. We are contemplating this decision. We are not sure whether it is a viable one or not, and that is what we are testing here now. Viability, using what the examiner is telling us, using net present value. That required Roman number 4. So let us start asking ourselves, how much are we saving? Yeah. And with that question, we start straight away by asking ourselves, what is the total savings before tax? What is the total savings before tax? Remember, I'm saying before tax. Why? Because when you look at this information given, the machine is expected to economize on electric power usage and repair costs, which will save the company 920,000 shillings each year. They did not mention anything on tax. So we know we cannot forget that tax is a crucial element when you talk about cash flows. So as much as it will be saving our costs, but all this saving is before the effect of taxation. So let us come and now ask ourselves, in year 0, will this machine start saving us in year 0 before we even buy it? The answer is no. We have to buy the machine. If we take that decision of investing in it, we buy it first, then is when the impact of cost saving will start kicking in. And what is the tune, or what is the impact? We'll be saving on electric power by 920,000 each year. At the same time, we'll be saving by reducing defective bottles. And the saving in that aspect of reducing the defectiveness of the bottles will amount to 120,000 annually. So the total cost savings is the 920 plus the 120. I hope, members, we are together. So that only happens from year 1 if we make that decision, not year 0. Year 0 means we've not decided. But if we decide to engage the new machine, then that is the first impact we expect. So allow me to go ahead and include that cost saving in terms of energy and reduction in defective bottles. And that will save us 1,040,000 in year 1 if we make the decision. I hope we are together. Then we ask ourselves again, if that's what happens in year 1, what cost savings will we have in year 2, in year 3, and in year 4, and finally in the last year? Did the examiner mention anything to do with the various years' cost savings? In this paragraph, they just mentioned the machine will save or economize power usage at 920 each year. This 120 also is annually, meaning without any further breakdown of differences in cost savings for the years within the useful life of the asset, that cost savings, we expect it to remain constant. So what do? This 1040 will run across all the 4 or all the 5 years that we have to use that new machine in case we decide to buy or replace the old one with it. Good. Now, after looking at this total savings we'll be having across the years, we ask ourselves, this cost savings, it started before tax. So what is the tax expense that we are going to incur in this total savings? And along the question, somewhere the examiner mentioned to us something to do with tax, and they said the company's corporate tax is 30%, and the required rate of return is 12%. So let us come. We are following on cash flows. We've talked about cost savings, incremental cost savings, and we are going to save the cost at a tune of 1040 every year. So what tax implication do we have on it? Tax expense. Tax expense, and this comes at 30% as given in that question. So what do? We're going to charge 30% on the total cost savings per year. And we start cost savings in year 1, not year 0. So 30% of the 1040. What do we have? 312. And now that it's a tax expense, it will affect our cash flows. So I will put a negative onto it like that. And this I autofill to year 5. And you realize the tax also remains constant across the years. Good. Now, you will ask yourself that this cost savings on this new asset that we want to engage. This is an asset.
Don Mwalimu, how did you get 1040?
Really? 1040 is just the total savings on energy, and the other bit was on the production on defective bottles. That was the information given.
Oh, okay, I see now. Okay, thank you. I
120.
think you added them.
Monica, I suspect you are still horizontal. Are you?
No, I'm
Monica.
awake.
All right. So we continue. Now, after we charge that tax, we now ask ourselves, this asset that we are intending to buy, will it suffer depreciation? Remember, we are talking about fixed asset. We cannot assume element of depreciation, and that should inform our first computation. Do we have depreciation? In the question, the examiner talked about the company provides for depreciation on a straight line basis. You look at that. So if it is on a straight line basis, how will we charge depreciation? Before I mention anything, can someone try to tell us how you think we should go about depreciation? Yes. Somebody? Somebody talk to us. It is not your usual depreciation the way we normally compute it. It is not the usual one. It is not the usual one. I want you to think with the scenario that we have. It is not the usual depreciation that you know of. Yes, it is on a straight line. Yes, I agree, 100%. A straight line. Someone try? Someone to try?
Should add it back.
Sorry?
Should add it back.
And how do we get it?
We take the
Yes.
we find the depreciation, then we multiply by the tax to get the DTS.
Yes, it is the depreciation that I want. Why do you want to give us a solution on how to handle it? Yet that is what we need to get first. It. Yes. That's a good trial. Thank you for that. Members, I want us to,
Purchase
yes?
price minus disposal value divided by number of years. Cost minus, yes.
Cost minus salvage.
The
Then you divide
number
by the
of years.
useful life, right? That is okay. Thank you. That's a good one. I agree. And that is just some bit that you are not talking to us about. Because members, I want us also to be alive to the fact that when computing depreciation, we have two sets of machines. We have the old one, which we intend to dispose. Then we have this new one, which we want to engage. All these machines are fixed assets and they suffer depreciation at the same time. Now, one we are selling off, one we are bringing on board. We have to, we have to find a mix in which we match the two depreciations and we get what we call incremental depreciation expense. And Nabira is telling us something I see from the chat box: depreciation of the new, less depreciation of the old. So we need that incremental depreciation. Both the two are machines, and we need to, we need to triangulate. We need to come up with a viable mix of the two depreciations and get the net effect on the incremental expense on that line of depreciation. Now, remember, we are looking at the cash flows, and whenever you charge tax, I want us to remember we have two approaches. We know the effect depreciation has on cash flows. I want you to connect the knowledge on the cash flow, preparation of cash flow statements. Normally, when you're preparing cash flow statements, you start with profit before tax. Then, what do you normally do? And remember, profit before tax, then you do your adjustments for non-cash items. Depreciation is normally one of the non-cash items you adjust. Then, you do not normally adjust tax because you cannot say tax is an non-cash item. Tax, you come on its line after adjusting for working capital. You come and ask yourself if there was any tax that was paid or not. Members, I hope you remember that very well. So in that part of asking yourself if tax was paid or not, it is not under the adjustments for working or the adjustments or correcting that your profit. But remember, in this other aspect here, we've charged tax on the total cost savings. And it is total savings on what? Total savings on the impact of that new asset. And yet, that very new asset suffers depreciation. So we have an approach where you deduct depreciation first on that cash flow, you charge your tax, then you add back depreciation. Members, I want us to get that part. You deduct the depreciation, you charge your tax, then you add back depreciation because it is a non-cash item. You are correcting your profits. In this approach, so that not to confuse anybody, you normally remember a concept that you did, which was called depreciation tax shield benefit. You remember that? I believe you do. Now, instead of deducting depreciation, charging tax, adding back depreciation, it is still the same as charging total depreciation, and then you deduct the savings that you have. You add the tax shield benefit. You add the tax shield benefit on that depreciation. The two treatments, net effect is still the same. You can adopt any of them and you'll still get the same answer. In this our approach, we charge tax on the total, And I want us to add the depreciation tax shield benefit. But first, we need to compute the incremental depreciation. So I will come and do that computation down here. Let me call it just working one. And what we want to do is to compute incremental depreciation expense. We talk about incremental because we are considering depreciation on the old and depreciation on the new, so that we see by how much are we going to incur extra expense on this line of depreciation, because that is the depreciation that we are looking at, incremental. Because remember, the cash flow that we are looking at here is the cost savings. What are the savings? So, in other words, what is the incremental benefit? What additional benefit are we going to get if we replace the old with the new? So, at the same breath, we also look at what extra expense are we going to incur on depreciation? Yes. So, to look at the incremental depreciation expense, we want to look at first, let's compute depreciation on the new machine first. Then we compare with the depreciation on the old machine. Then we see this new machine, how much are we going to pay on depreciation? Then the old one, which we're disposing, how much was the depreciation? Then we see what is the incremental depreciation expense. That is the motive here, computation of depreciation. Let me just say the new machine. New machine, so that is easily understandable, so that you understand it easily. So, computation of depreciation of the new machine. Now, the new machine, we start with the cost, because depreciation is normally subjected to the cost, yeah? Cost of new machine. But remember, that very new machine has a salvage value, which you are given. Let's go and look at it. You are told the new machine, as the machine is expected to have an estimated market value of 600 at the end. So the purchase price of the new machine is given as 4.7 and the useful life is 5 years. And it is expected to have a scrap value of 600. So in computation of depreciation using a straight line method, we have to consider this information. We have to knock off the salvage value from the cost, and we divide by the useful life, we get the annual depreciation, the same way good members had mentioned in the chat area. Very good. So let's go ahead and do that. So the cost of the machine, I believe we've all seen, the cost of the machine is 4,700,000. Let me just confirm if that is true. Yes, it is. Then the salvage value is 600. So I will bring salvage value. Sometimes you call it residual. So it is either salvage or residual value. Residual value. You can call it either term, and it is 600,000. I hope that figure is also correct. I've picked it correctly. Do I need decimal places? Note now. Then also, they told us that the useful life of this new machine will be 5 years, like that. So if we are using the straight line method of depreciation, the same way members have mentioned, we are taking the cost, which is 4.7, we subtract the salvage value, we divide by the useful life, and then that will give us depreciation per annum. Depreciation per annum. And I want us to just do it. Let me just push this here a bit, so that this our depreciation per annum, I want it to appear here. So we are following that formula, cost, which is 4.7, minus residual or salvage value, which is 600,000. I close that bracket. Whatever we are going to get out of that, we divide by the useful life of this new machine, which is what? 5, like that. That will give me 820,000 as the depreciation per annum. Are we together, members? Confirm that I'm not alone. Confirm that I'm not alone. Good.
But you divided? I missed it, sir.
Mercy.
Yes.
Mercy, how are you?
I'm fine, sir. Good morning.
Okay, good. Morning to you. Okay, I don't want to talk. Now, see, what we've done, take the cost of the new machine, subtract the salvage or residual value, whatever you get, divide by the useful life of the asset. Is that okay, Mercy?
So thank you, sir. I got it.
Good. Let's move to the next part. After computing depreciation on that new machine, we also don't forget we have an old fellow. And this old fellow, we want to throw it off, but we need to also ask ourselves if it is going to save us cost, money, or the old machine is still viable. So let's compute depreciation. And this one is on the old machine, now. So as we compute the depreciation on that old machine, we follow the same format. So how much cost of the old machine are we using? Cost of old machine. Now, I want to go to the question. The question started by saying the old machine has a current net book value of 2.4 million with the remaining useful life of 5 years. And the old machine has an estimated resale value of 200,000 at the end of its useful life. They did not say has a cost. They said has a net book value. So this net book value at the start, it will be used as the cost of the machine because we are picking net book value as at the replacement date. As at the replacement date. I want you to note that part. This depreciation on a straight line basis, normally we start with cost. But in this case, we pick that value as at the date of replacement to represent the cost of the old machine, which is 2.4 million. So I will write there 2.4 million like that. Then let me just put a comma style here. Remove the decimals like that. 2.4 million. How much did I write here? This is 2 billion. It should be 2.4 million like that. Then we also have its salvage value or disposal value or residual, the value, let's call it residual. So the residual value of that old machine, how much was it? Let me check again. It is 200 and the useful life is also 5. So we bring on board the 200 and the useful life is also 5 years. So the same method, the same procedure, let's get the depreciation using the straight line cost minus salvage value divided by useful life the same way. So depreciation per annum there, we do the same. I open a bracket, cost minus residual value, close bracket, divide by the useful life. I have depreciation per annum on the old machine as 440. Now we compare these two depreciations on the two machines to see by how much is our depreciation expense going to shoot up, going to increase. That's what we call incremental depreciation expense, incremental depreciation expense. And we should get it at that point and see how much has the depreciation gone up. And we have here 380,000. Now, this is the incremental depreciation expense. And because we are looking at the cost savings, the impact of the new machine, this is the expense that you want to look at. This is the depreciation that we are going to charge in our cash flows, in our statement. So I will come to our cash flows here that we were building up. And I told you we are adopting an approach of looking at the depreciation tax shield benefit. So you can opt to go the other way. Deduct depreciation, charge tax, add it back. Net effect should be the same. In this approach, charge tax on the whole tax savings, on the whole savings. Then after you've charged it, then now you only add the depreciation tax shield, because you should not charge tax on depreciation. Depreciation is a non-tax item, it's a non-cash item. So you do not charge tax on it. That's why we need to deduct it first before charging tax. But because we charge tax on everything, we look at now how much tax shield did that depreciation bring on board. So we add depreciation tax shield benefit. I'm using DTSB, depreciation tax shield benefit, or you can call it DTS, just depreciation tax shield. Whichever way, it's okay. So that depreciation tax shield, how do we compute it? Just take the tax rate that you are given, you multiply by depreciation figure, the depreciation expense, the depreciation expense. In this our case, we're dealing with incremental depreciation. So we just charge 30% of that, I close bracket, and because you've already computed our depreciation expense at now 380, it is under our working one. So why don't I just say working one, so that you know where we are getting it from? So I will come here and say 30% of what? 30% of this our incremental depreciation, this expense, 380. Yes, and because I don't expect that figure to change, the depreciation figure remains the same. Why don't I just go ahead and lock that cell? You see this cell M44. Why don't I just go ahead and lock it? Because that depreciation figure is going to remain constant. So once I lock it, I will have my depreciation tax shield benefit, and that will remain the same across the board. 30% of that will be our tax shield benefit. We add it back, it is an inflow. So that would give us the net, the effect of that tax on the savings. It balances out, and I believe you remember the other approach I've just mentioned. Deduct depreciation, then you add it back. Now, we also ask ourselves, and in terms of cash flows, remember we are following on cash flows. We started by savings. We've checked on the effect of tax and then depreciation manipulation there. Now, remember, when looking at cash flows, you also ask yourself, are there any terminal cash flows that you're going to get? And when you talk about terminal cash flows, we also have two fellows here, two giants here, two assets here we are comparing. Remember, we have the old asset we are throwing off. We are thinking of disposing it off. And we are only weighing the options whether it is a good idea to sell it and buy a new one. So as we try to weigh the option, we will have to work with both of them together to look at the cost aspect. Are we saving or we are losing? Now, in doing so, when we come to cash flows and we ask ourselves if we will benefit any terminal cash flows, and remember, terminal cash flows normally come at the end of the useful life of the asset. Whatever terminal cash flow that we are going to realize in this our cash flow statement that we are following up, we have to consider the incremental bit of it. Remember, we've checked on depreciation and we've looked at the incremental cost, the incremental expense. The same way, we need to look at the incremental bit of the terminal cash flows. So I believe you understand that perspective. So someone is saying, repeat on how to lock a cell. And Dory has already responded. Karen, use F4 key. If your F4 key alone is not working, use FN F4, function F4. Function key is between your Windows and Control or Windows and Alternate, depending on the computer you have. So either way should lock. If all those two options are not working, do not beat your head. Just go and insert $signs manually. You'll be all good. Now, we also consider here incremental terminal cash flows. Incremental terminal cash flows like that. So because we have two assets, we also have to check on any incremental terminal cash flows. So because we have two assets, we cannot ignore. We don't only look on one side. So let's also do a breakdown for the second bit, and we talk about incremental terminal cash flows. Incremental terminal cash flows like that. So on incremental terminal cash flows, we start again the same way by looking at our new machine. What is the terminal cash flow on our new machine? And I want us to go to the question and see the framing. For the new machine, we were told, apart from the purchase price, the machine is expected to have an estimated market value of 600. So the market value is 600 at the end of the 5 years. And then if you look at what other information do we have concerning the new machine that we need to use here, I think this, because it forms part of the terminal cash flow, we have to consider the 600. And then the new machine, what was the terminal value of the new machine? The old machine, sorry. We are told the old machine has an estimated resale value of 200 at the end. So we need to compare the two, because we are comparing what we are getting from the old machine at the end and what we are getting from the new machine at the end, so that we see by how much what is the difference in that incremental terminal cash flow. We have to get the net effect. And there, we just take the simple approach, salvage value of the new machine, then, and salvage value of the new machine, how much was it? Let me see very fast. New machine. I see there it is 600,000. Then we compare that 600,000 with the salvage value of the old machine. So when we compare, we write there less salvage value of old machine. Was it 200 or something? Let me confirm again. Yes, it was 200 there. So we less 200,000. And that should give us the incremental salvage value. Incremental salvage value. So that incremental salvage value should be the net effect of these two. The net effect of these two should give us the incremental salvage value like that. So we just get the net effect, and I see I'm getting 400. So that should be the incremental salvage value. But members, I want you to remember, if there was a mention of anything to do with working capital, if there was a mention of working capital, you have to consider working capital at this stage, because working capital is normally recovered in the end. So any injection of working capital in the new machine, you compare or you compare with, not, you don't add, you compare by subtracting the net effect if you have the old machine. So working capital engaged in the new machine and working capital for the old machine, because that difference is what we call incremental working capital. So that incremental working capital would also affect the terminal cash flow, because you are recovering that working capital that you inject at the start. At the end, you have to recover it. So it will form part of the incremental terminal cash flows. Members, I hope you get that part. Because in this question, we don't have any working capital mentioned, so we don't have to worry about that. But if it was there, working capital is normally recovered in the end. So for now, our incremental salvage value is 400,000. So we go and take care of the incremental terminal cash flow. And remember, terminal cash flows is realized at the end of the project life. Year number 5, that is when the project is ending. So we will consider that cash flow. And let me just write here working 2 so that you know where we are getting the figure from. I want to refer to it, bring the 400,000 there. Good. So it is an inflow. That's why I'm adding it as a positive. So with this, we need now to ask ourselves, in year 0, remember we've not written anything in year 0. What happens in year 0? It is in that year 0, that you need to ask yourself, what type of cash flow am I putting in year zero? And that is your total initial outlay. Total initial outlay, the total cost, the total investment from the start. So did we compute the total investment? We haven't. We haven't computed it. And I'm seeing a question. Liz is asking, show us how we take care of working capital. All right. It's okay, Liz. It's okay, Liz. It's okay. It is okay. It is okay. What I want to do is just to push this a little bit down and show you, in case you have working capital, you will say you want to add. You see, the net effect of this terminal value, for example, comparing the salvage value of the new machine and the old, whatever you get out of that, you will add incremental working capital. Add incremental working capital. And let me put this in italics. You know, when I talk about italics there, it has made me remember something. Someone was telling his friend that if you are somewhere and you test your working and you realize you start working in italics, then it is time to go home. So it was an interesting thing anyway. So you add incremental working capital. So how do we get incremental working capital? Let me just add another row there. Incremental working capital, you compare working capital on the old machine and working capital of the new machine. So we start with working capital of new machine. So this is the working capital that was included or injected when engaging or purchasing the new machine. That amount, whatever it is, you will compare that amount with the working capital that, because remember, whatever working capital you invest at the start, you recover it at the end or in the end. And it is that bit that you are recovering it that affects our terminal cash flows. So that's why we are bringing it at this point. So you compare again the working capital on or of the old machine, What's happening with my keyboard? My keyboard normally misbehaves a bit. So the working capital of the old machine, and you compare the two, or the difference, and the difference is what will give you incremental. So I can put this in bracket. It will not affect our computation because I did not connect, my formula did not cover these cells. So that's why our answer is still safe here. I'm just showing you the treatment. Working capital that is recovered from new, working capital that will be recovered from old. And all of them are recovered in the end at the terminal cash flow level. So this will give us incremental working capital. So it is that incremental working capital that you get here, that incremental working capital, you will add it to the whatever you got up here from comparing the two salvage values. I hope this answers that bit. Let me even highlight it in yellow. I hope that treatment guides you very well. So we've already taken care of the terminal cash flows. I was asking about the initial investment in year zero. Remember, if you decide to engage or buy the new machine, you are investing. That is an outflow at the start. As we look at the cost savings, as the savings that we are going to get, we need also to ask ourselves, what initial cost, what is the investment in this new machine when we decide to engage it? What is the investment? So that is what I want us to do now. And that is what the format I gave you from the start. Do you remember it? I told you to just keep it aside. Its time is coming. Its time is now. Its time is now. So cost of the new machine. How much do we spend? I just want to replace whatever I wrote here using figures. I don't want to interfere with this format. I know we don't have all these elements, but in case you meet them next time, you will know the treatment. So I just want to use this format we had written to get to compute the total initial or incremental initial costs. So the initial investment or the purchase cost of the new machine, we were given here as how much? this paragraph, the new machine has a purchase price of 4.7 million. That's what I want to bring, 4.7 million, like that. So that 4.7 million, I want to remove this excess now. I want to remove this excess now because I believe you've already known how we are treating them. I believe we should know how to treat them now. I remove the decimal. So now 4.7 million. Then we ask ourselves, add any incidental costs or any additional expenses that are involved in bringing the machine into the premises. In this question, was there any mention of any other additional costs? I did not see any. I'm still checking. I'm not able to see if there was any freight charges, custom duty, installation, assembling, and all that. In case you get any of them, please capitalize them. Because in this case, it is not there. We do not, we just skip those other adjustments. In case they're there, you know how to treat them. Then we ask ourselves, this part on the old machine, remember, this will give us the total cost of the new machine, and the total cost of the new machine is the net effect of all this. In case there are adjustments, it will affect this value. But now, this old machine that we want to replace, when we sell it, how much are we getting? When we sell it, how much are we getting? Proceeds on disposal of the old machine. How much are we getting? Whatever we are getting when we sell that old machine, we will deduct it from the cost of buying the new machine. Why? We are looking at incremental initial cost. So we want to deduct what we are getting. When you get this money, and yet you are supposed to spend 4.7, how much have you spent? You've spent the difference. And that's what we are looking at. So how much are we going to get if we dispose the old machine? Let's come and check. Did they tell us? Did they tell us? Yes, the existing machine's current disposal value is estimated to be 1,060,000. So that is what we're going to spend, 1,1060,000, like that, 1060,000. So if the cost of the new machine is 4.7, and when we sell the old one, when we dispose it, we're going to realize 1060. So the difference is what we are going to spend, the net effect. So was there any investment in working capital? We did not see any mention of working capital, so that is not there. That one has no problem there. So we come there and see the net effect. Let's get the net effect. Cost of the new machine with, after adjusting for all this, we have 3640, 3640. And I have a question. And my question is this. Yes, we are going to have incremental initial cost of 3640. But then, is there a tax implication? Is there tax implication? Because we are disposing, we are selling this old machine. And when we sell the old machine, this is money. We are realizing some money out of it. Is there tax implication? Somebody? I'm just trying to think. When we sell this old machine, is there tax implication on the sales value? Is there tax implication?
I think, Walimu,
Yes.
I think we need to get the loss or gain on the disposal. Then if it's a loss, we will less the amount. We multiply by the tax, then we less. If it's a gain, we multiply by the tax, then we add the amount.
Very good. Thank you. Thank you. Now, members, if we realize a gain on disposal, we pay tax. If we realize a loss on disposal, sometimes we call it capital loss because that machine is a capital asset. When we realize a capital loss on that machine when we dispose it, that will be a tax saving to us. So we have to check and ask ourselves, was there loss or gain on disposal? So yes, Kevin, thank you. I see from the chat box you said loss the tax saving. That is correct. So we need to ask ourselves those two questions and see if there will be any tax effect on this, the value that we get. So I want us to make it clear. Let's go to working number 3 and show it there. Now, in working number 3, as we show it, we ask ourselves, what is the impact? And we say, let's look at the disposal. disposal of old machine. And we ask ourselves if we are disposing it at a loss or at a gain. And then we see implication on tax. We are either saving or paying tax. Now, how much are we going to get when we dispose? And we compare with the net book value. So I want to start from net book value. Net book value of old asset. So this asset, the worth of the asset was given in the question. The asset was worth 2.4 million. So that is the book value of the asset, 2,400,000. And this asset, which was at 2.4 million, we sold it off. We disposed it at what value? This will give us proceeds on disposal. Proceeds on disposal. How much did we get when we disposed of this asset? And what we got in disposing the asset was also given in the question. At what point? Where was it? This one, the existing machine's current disposal value is 1060. I think we even looked at it just a few minutes ago. So 1060. Now, how do we know whether there is a loss or gain on disposal? Now, if whatever you get when you sell it is higher than its initial net book value, then there is a gain on disposal. If what you get when you sell it is lower compared to the net book value, then you've sold at a loss. So in this case, you realize that what we are getting by selling it is only 1060, but the book value of this asset was 2.4 million. So we are losing. We are selling it at a loss. If the book value was 2.4 and we can only realize 1060 out of it, there is a loss. So we say there is capital loss. Capital loss or loss on disposal. Loss on disposal, like that. So loss on disposal, we compare and we say, if the net book value was 2.4, then we can only get 1060 out of it. We've lost some 1.34 million. So if it is a loss on disposal, then it is a tax saving to us. If it is a gain, we pay tax on it. So because it is a loss, we talk about tax saving like that. How much are we saving? We just take the tax rate, which is 30%. It was given by the examiner. We multiply by the capital loss or loss on disposal, and it is this 1340. So how much are we saving in terms of tax? 402,000. Now, members, when we save this tax of 402,000, at what point are we saving this money? In other words, at what point are we disposing the old machine? Remember, when you decide to engage or buy the new machine, after you made this decision and you want to dispose the old machine and buy the new one, it is at the start. Remember, we are told this model of the cash flows we are building here from year 1 to year 5, we are just trying to make a decision, but we have not yet engaged that new machine. We are just weighing this is just a model to help us see how much are we likely to save. Are we likely? And that's how we came up with these cash flows. How much are we likely to get as a tax shield benefit from the depreciation comparison? That's how we came up with this tax shield benefits that we are going to get. So in that sense of looking at it, if we go that direction of bringing on board the new machine, we dispose of this old machine from the start because we've made a decision to do away with it, because the option we are about to engage in is more viable, is saving us a lot of cost will improve our performance and the cash flows. In that sense, this tax saving will affect. In that sense, this tax saving will affect our incremental initial investments, because we are disposing this machine at the start after we made that decision. So that what happens is in our computation of the amount that we are going to spend at the start, we call it here the incremental initial investments, because we are comparing the old and the new. When we dispose the new, and remember, when we are looking at these incremental investments, the initial investments, we also considered what we are getting when we sell that old machine. Now, if there is a tax saving involved in selling the new machine, the effect, that amount that we are saving, we have to include it here. Members, are we getting that explanation? I just want to be sure that we are together. I'm not alone. I'm not speaking to myself. Members, confirm to me that we are together. Confirm to me that we are together. Good, good. If we are together, then now let's go ahead and take care of that tax savings, and it will affect our incremental initial costs. And that effect, I just want to push this a little bit down because of the effect of the tax saving. If we were paying tax, you should know again how it will affect. So remember, initial investment is the cost we are incurring at the start. If we have a tax saving on it, then it will reduce our costs. So what we do is less tax savings. And we've done that tax savings where? We've done it in working 3. So I just want to refer to working 3 so that you can be able to see where we are getting that figure from. And the tax saving that we are lessing, I just want also to refer to it, that 402, like that. I'm bringing
that
and
tax saving,
lessing it from our
we are
costs.
adding it or we are lessing it?
That's what I'm still talking about. We are saving. Remember, we are looking at initial cost, what we are spending at the start. If what we are spending at the start, we dispose the old machine and we realize we are having a tax saving, it cannot increase what we are spending because it is a saving. It will reduce our initial cost, our incremental initial cost by that amount we are saving. Aman, are we together there now? Aman?
Yes, we are together, sir.
Yeah, so that effect will affect our initial cost, and I want to include that adjustment like that. And therefore, our incremental initial cost comes to 3,238,000. Now, this incremental initial cost, I was looking at it because it is what we are spending at the start, the initial incremental cost. So in our computation and following up of the cash flows, we will come and ask ourselves, what was the initial cost? Initial cost, like that. And the initial cost is normally in year 0. If you make a decision to purchase the new machine and dispose of the old one, this initial cost has to come in place. And the initial cost that we've just computed, it is an outflow. So it will come as a negative because you are spending. Where is it? Initial cost, it is up here, this one. So I'm bringing it in here as an outflow. This is cash flows we are following here. So all these adjustments is what is going to give us net cash flows. All that is what is going to give us net cash flows. Net cash flows. So we get the net cash flows from the start. All this, then we do the same to all the other years. Then I put a comma style, and because I don't need decimal places, I do away with them like that. And there we have our net cash flows. Now, from this point now is when we want to make a decision. We have projection. If we want to engage at the new machine and dispose of the old one, we now have what we expect as the net cash flows. We also already have, if we decide to go that direction, how much initial cost are we going to incur? This which we've just computed here. And I hope you are following. Now it is a point in which we want to weigh the options. We want to see, is it viable to go this route? Is it a viable decision to go this route given the net cash flows that we expect and given what we are supposed to spend at the start in case we decide to go that direction? Is it viable? So it is the viability that we are testing here. And it is the point when now we want to look at what the examiner was telling us. Remember, in our computations, we've answered Roman 1, initial net cash outlay. We've answered Roman 2, incremental operating cash flows. We've answered Roman 3, terminal cash flows. Now, we are at the decision level, Roman 4. I hope you are following. Using NPV, advise the management whether or not to purchase the new machine. We have our cash flows, so let's see if the management will opt or advice we are going to give them whether to invest or not to take that route. And NPV is that evaluation tool we are supposed to use. In using NPV, the examiner gave us some information in this. After the corporate tax rate of 30%, they said with a required rate of return of 12%. Required rate of return of 12%. And 12% is our cost of capital. So what do? We come here and say cost of capital is how much? 12%, like that. 12% like that. And the 12% will now help us to do our NPV. But members, I want you to be very careful here. Kevin, thank you so much. You've given us the formula and reminded us that NPV is the present value of cash inflows we compare with the present value of cash outflows. But the cash flows that we have is not very direct. And I want us to look at it critically. Remember, the cash flows from year number 1, and I hope Kevin is listening and the rest of the members. From year number 1 to year number 4, I want you to attest to it that our net cash flows are the same. 842,000, 842, 842, 842. Those type of cash flows, we call them regular cash flows. How many years are they running? The 4 years. Then, when you look at year number 5, its cash flow is different. Why? Because we have a terminal cash flow of 400. It changes the figure to 1242. This cash flow standing alone in year 5, we call it irregular cash flow. So, when discounting these cash flows, we have an approach of treating the two separate, regular cash flows and irregular cash flows. We bring both of them to present value so that we conform and agree with our friend Kevin, who has told us that NPV, let me just write it here because Kevin has told us a very important thing. Kevin has reminded us that NPV is equal to the total present value of cash inflows. You compare with the total present value of cash outflows like that. So for us to get the total present value of cash inflows, we have to get the present value of the regular cash inflows plus the present value of irregular cash inflows in year 5 to get the total present value of cash inflows before we eventually compare with the initial investment, which is in year 0. I hope members we are together. So let us go and get the present value of regular cash flows. Present value, PV of regular cash flows, like that. So to get the PV of regular cash flows, and we are getting the PV of the regular cash flows for the 4 years. Remember, it is only 4 years that we have the regular cash flows. And I believe that you know at this point that we can use the present value functionality in Excel to get that PV of the regular cash flows. So I will come here and say present value And you can see with the description, it returns the present value of an investment, the total amount that a series of future payments is worth now. And the future payments are all regular. So I will pick it by tab. I pick on the rate. After I pick on the rate, then I put a comma, and then it is asking me number of periods. Number of periods. How many periods are we having? It is 4 years. That's when the regular cash flows are running. Year 1 to year 4. Then I put a comma and it is asking me PMT. It is asking me the PMT. So, members, PMT is a payment. A payment is normally giving us a negative output. And in this case, we are looking at the present value. So to cancel out the negative output of the usual PMT function, PMT means payment. Now I will put a negative, then refer to one of the cash flows. Refer to one of the cash flows. That is the constant payment. Remember, when doing loan amortization, we normally use the PMT function. That PMT function shows you the installments you pay every month or whatever period we are talking about. Now, I refer to that cash flow. It is a constant amount for the period of 4 years. So I believe someone will not get confused. Why are you putting the negative? I hope now we get it. Good. Now, after that, I told you that in any Excel formula or any Excel function where there are parentheses included within the function itself, those are not mandatory. You can opt to take care of them. You can as well opt to ignore them. You do not have any problem if you do either. So you can opt to put a 0 and 0, or remember, look at the PMT function. PMT function normally gives us when are you doing the payment or when are you receiving. And when it is a payment, because you are using PMT, you tell Excel that I'm paying at the end of the period or at the beginning of the period. Now, in our case, these are cash flows that were realized at the end of each year. So when we use 0, it represents at the end of the year. So you can use 0 there. And even as well, if you don't put all the 2 zeros, like I mentioned, your answer should still be okay. So I close that bracket and confirm. And I have my present value of the regular cash flows. And in this case, because we are dealing with the present values, I believe decimal places are now coming on board. So let me just include the 2 of them. I can as well ignore them, but I know they're also important at some point. Members, I believe we are together. We move to the next bit. Good, good. Now, after getting the present value of the regular cash flows, Monica,
Mwalimu, tebu click
what figure do
again
you
on
have?
that. I have 4,452,754.
You have 4 million. You have a lot of money, Monica. Can you give us some of it? We only have 2 and you have 4. Now, Monica, do you have your net cash flows the same as ours?
Oh, okay. I see the net. Okay, I have seen where the issue was. The cash
All
flows.
right.
I'll adjust.
All right. So we have the present value of regular cash flows for the 4 years. So let's go to the 5th year where we have the irregular cash flow. And when we go to the 5th year, as we look at the present value of that irregular cash flow in year number 5, I would want us to even adopt, because we cannot use the PV method here. This is only cash flow in 1 year. I would want us to discount it using the formulas that we already know. So I want us to get the present value interest factor. And I had given reminded you, and I believe you even also know, but it's good to always remember that the present value interest factor is normally 1 plus r raised to negative n. 1 plus r bracket raised to negative n. These are formula we all know. And now, when you talk about now n is the number of period. Yeah. So this is present value interest factor for year number 5. Remember, we are dealing with year number 5. Year 5. Let me write there year 5 so that when you look at it, you'll remember year 5. Now, with that, let's go ahead and now get that value factor. Because we don't have tables here, but with Excel, you can be able to get the discounting factors very easily using that approach. So 1 plus R, what is R? R is the discounting rate, the cost of capital. Then I close that bracket. Then I say you received negative what? Negative 5. That cash flow is for year 5. So that will give me a discounting factor there. Let me put into 4 decimal places, and it is 0.5674. Even if you have tables besides you, you'll be able to realize that the discounting factor in year 5 at 12% is the same 0.5674. Now, let us get the present value of this irregular cash flow. So I write there present value of irregular cash flow. And the irregular cash flow, remember, it is only in year 5. I will keep writing that so that you can be able to connect very well. Now, we have the discounting factor. Do we have anything much to worry about? The answer is no. We have the cash flow, we have the discounting factor. How do we get the present value? Pick the cash flow in year 5. You multiply that by the discounting factor, you have the discounted cash flow. And it is here 744,744.15, like that. Very good. Now, if we have all those present values, now why don't we follow this formula of NPV and get our total present value of cash inflows? Current PV is 1 plus R raised to negative n, and that's what I've done to get our discounting factor. Are you able to see it, Karen? Karen, confirm to us that we are together. Karen, confirm we are together. Confirm that you okay. Very good. So we
Mwalimu, that
continue
one
now.
for 704. Hebu kasa hapo.
Yes.
Hebu weka kasa kidogo.
Yes, Kevin, the answer is there. Vincent, is it Vincent or Kevin? It is there. Let me see. Now I've clicked on around. Yes, this one here. You just multiply the discounting factor, the PVIF that we've gotten, by the irregular cash flow in year 5, the 1242,000. That's how you get the present value of that cash flow. Are we okay, Vincent?
Hapo.
Very good. Now, let us get the total present value of cash inflows. We compare with the total present value of cash outflow or the initial investment. Then we get the NPV. From there, we'll make a decision whether this decision is viable or we reject it and retain our old guard, our old machine. So let us get total. Total present value of cash inflows, like that. And this is the total of the irregular plus total of the regular one. And there we have our total present value. And there we don't have any problem. We can also only go ahead and see what is the net present value of this decision. And there we compare the total present value of cash inflows with the initial investment or the total present value of cash outflows. And because our total present value of cash outflows is already negative, I simply want to add it because the net effect will be negative. I'm adding, but we are subtracting. I hope somebody is not getting confused. We normally subtract, but I'm putting an addition sign. Positive and negative gives us negative. And I can see that I have 24,192.3. Now, this figure is positive. Whenever NPV turns out to be positive, what do we say? What do we say? What do we say? We say viable. Thank you, Hortensia. Thank you, Hortensia. We say this decision is viable and we can go ahead and now replace the old machine with the new one. That is the decision that the examiner was asking in note 4.
Mwalimu, I have a
Members?
question.
Yes.
On the computation of the PVs of the both regular and irregular,
Yes.
is there any harm if you combine all of them for the 5 years? Because I used that using the NPV formula and got the same answer as that.
It is okay. There are always various approaches, but I picked on this because it will really make somebody understand. I picked on this so that to just make it clear about the regular ones and the irregular one. But you are still correct because you will still arrive at the same answer. All right, all right. So members, that winds up that question. I had thought before that we would get time to look at the other one. Which other question did I share? I shared something else. I shared also a question on nominal NPV, nominal NPV. Now, because of the time we have left, we cannot be able to start and finish. So I feel we accept that this is all we could do with the time. And thank you for braving the morning cold. Wishing you all the best. Continue revising.